You work hard, you get your raises, your income goes up, and then tax advantages go away. And it's very frustrating. And on we go.
That is the truth.
This is John Hicks, financial advisor, founder of J. Hagen Capital. I'm Heather Branch here to ask John about what you can do to better position yourself for the years ahead in this second phase of your financial life. Of course, your retirement goals. So as you were listening or watching this podcast, feel free to reach out to us. We're here for you. The website, retirementsolutionshow.com. You can also click on the links we've got posted in the show notes. Now, I don't have to explain to you, Mr. Hicks, that taxes are confusing as all get out. The tax code, well, we've talked before about the amount of pages that are involved in the current tax code as of this podcast recording.
Over 76,000 pages of the current tax code. No joke, 76,000 pages.
No
I don't even think that includes some of the special stuff. Maybe it does. I can't remember.
So,
but I mean, that's a lot.
Right, to say the very least. So, again, and this is me speaking and playing the listener, because I don't even really know exactly what it is I'm asking you here. That's how hard it is for me to wrap my brain around it. So I'm going to ask you to speak slowly, good sir. There are some advantages in retirement planning that disappear as your income goes up. Those things include the new $6,000 deduction for being over 65, your ability to contribute to a Roth, the lower premium for Medicare Part B, your IRMA, the taxing on Social Security. Again, these all depend on keeping your income level down. But of course, we all want our income to be going up. Because even in retirement, inflation goes on, life goes on. This is where I get confused. I realize it's my own question for you, but is there a part of tax planning that tries to keep our taxable income below certain levels? What is it that we need to be doing in this space?
Yeah, that is probably the biggest. That's probably the biggest question when it comes to tax planning.
Yeah.
What are we really even talking about? And here's how it kind of comes this way, right? Most people, when they go into retirement, they're thinking, how do I get the biggest income possible? Some people go on that line. But if you're a pro, it should be a slightly different game. It should be, how can I control my taxable income so that I can maximize my benefits, but minimize my tax bill, right?
Okay.
And so that is really the thing. That's what the pros are trying to do. So the really savvy family offices, the billionaires, the multimillionaires, and many of you guys are out there listening today. The thing of it is that most of it's a little bit of a change of a paradigm of our thought. It shouldn't be, hey, how do I pay the least amount of taxes this year or this quarter? It should be, how can I pay the least amount of money that I've saved my whole life for? How do I pay the least amount to the government in order to get it to the next generation or to spend it the way I want? That should be the thought. Now, the OBA and these new tax changes that happen, they create not just a simple strategy for taxes, there are actually cliffs built into the tax code. And if you do just one more dollar of income, or you can't use $1 of a deduction, it can cost thousands of dollars. As a matter of fact, you mentioned one of them. So Heather, one of the things that that most people are not necessarily always aware of, the new federal tax code, if you're over 65 years old, as long as your joint income is less than $150,000, then you actually qualify for a $6,000 credit or deduction on your taxes. So that is a big deal. So we want to make sure that everyone can get that. And a lot of people say, well, John, my income's way too much. Well, should it be? We're going to talk in just a second about an example of a client that we helped completely change their income, where it came from, so they can qualify for these deductions. But not only, losing out on deductions, some people, because they do Roth conversions and they thought that they had the math right, unfortunately, they've put themselves into a Medicare premium tailspin, right? Where they can potentially pay, Heather, up to $4,000 more a year in extra Medicare premiums or IRMA penalties because of their income. And sometimes by purposefully doing Roth conversions, it creates that. We know ways around that, but we have to plan correctly. Of course, if you have too much income, 85% of your Social Security becomes taxable, right, at your highest marginal rate. So that can suck tens of thousands of dollars a year, unfortunately, out of our pockets if we don't plan correctly. And it can also change our ability to create or to contribute to a Roth IRA. So when we look at all these things, it really boils down to, we want our clients to know we do strategic income management. every year, and this is why I say when we're designing a tax plan, we're really trying to design it for the next 15, 20, 30 years, for the entire length of retirement. But every year we have to run that year specific math, and it changes a lot of things. It changes on years we have a tremendous boom in the market and we have tremendous gains. There are several different things we can do to mitigate some tax bills or to defer other tax bills. That can be very attractive. Now, other situations, we say, wow, this year we have so much income from last year. Let's go ahead and reserve that. And let's go ahead and make a much larger conversion and not take income in years, let's say 2 and 3. The difference can be enormous when we're understanding bracket management. So the two things I just mentioned, should we be strategic in how we plan our income? Always in retirement. And secondly, should we make different changes based on math for that given year? Always. The choreography of how we do Roth conversions is really more of an art as opposed to a science. Most people just look at the tax code and they think there are specific sets of numbers and rules. No. It's how you massage it. It's the choreography. You can dance like a heavy metal a mosh pit guy, or
Uncle
you can
Sam,
dance like
right, dance?
right, or you can dance like the Russian ballet, right? So it's very, very different in how it comes out at the end, but the result is going to be based on what are you looking for? Are you more of a Metallica fan, or are you more into Russian ballet? It just depends. Everyone's going to be different. But when we're going through those things, then things also pop in like capital gains harvesting, things like that. So all of these things are really important, and that's why we have to have an ever evolving tax strategy. Every year, the government's potentially going to change tax rates. I mean, in 2026, this is a midterm election year. So we don't necessarily know after November what next year's tax code is going to be. We have ideas, and they're not all bad, no matter what happens in November. But the idea is that could it change? It absolutely could. So we have to make sure that we have a flexible plan that allows us to potentially save as much as possible. And guys, if you have saved millions of dollars in your retirement accounts, you could potentially save hundreds of thousands, if not millions of dollars, by applying the right tax strategy. That is not inflating the truth at all. We have actually seen people. Let me give you an example.
Okay.
So we were working with a couple who decided to retire at 63. Now, they were living off of $80,000 a year from their traditional IRAs, which sounds perfectly fine, right? Wrong. They were losing out on the senior deduction. They were paying higher IRMA surcharges than they needed to. 85% of their Social Security was taxed. So what we did is we took their exact same income needs, but we just restructured it. We started pulling $40,000 a year from their Roth IRA. We took $25,000 a year from their taxable brokerage account, which was primarily qualified dividends, and we only pulled $15,000 from their IRA. Their lifestyle did not change one single bit, but we reduced their tax bill by over $12,000 a year, and they dodged the IRMA bullet. That's the bigger thing. So that actually saved them potentially another $1,500 to $2,000 based on what they were thinking about doing. Guys, that is tremendous. An extra $12,000 a year is $1,000 more a year that you could spend, or you could give, or you could gift, or you could have completely just compounding for you. That is $1,000 a month in that one simple example. So what we need to do is we need to make sure we're calculating our provisional income correctly. If you don't know that, does your CPA tell you about that? Does he ask you those questions? What about your tax person? Does your advisor do that? If they don't, guys, I hate to tell you, they should be doing that. That is what our firm does for all of our clients. We want to advise based on income. What are the things that we can do to put our clients in a better position? If you have not started Roth conversions, I'm going to ask the question very bluntly, why not? We know for a fact that the government is $40 trillion nearly in debt. And there are no ways to make that back except to take it from us. Realistically, tariffs can only do so much. So we have to ask ourselves, are we doing the right thing by getting our money in tax-free accounts? We have to consider that. And every year, we need to consider in retirement where that income is coming from. It shouldn't be changing drastically every year, but it should be methodical and it should be systematic based on how to get the lowest tax bill to give to the government at the end of the day. So those three things done correctly can put tens of thousands, if not hundreds of thousands of dollars in your pocket if done correctly. If you don't know how your plan works, give us a call today.
RetirementSolutionShow.com is our website and where you can go to begin the conversation with John and his team, understanding, as John just pointed out, we started the conversation with how complex tax planning is. It continues to become more and more complex. To your point, the national debt, I don't know if anybody's calling it a crisis besides you and me, but how can you not?
Yeah, it's hard to get around that.
Yeah,
right.
yeah. And so many savers and investors are worried about how it's going to affect them in the years ahead. And that's an understandable concern. John and his team helping folks figure it out every day, how to create a better withdrawal strategy to help potentially reduce your taxes, which you have to owe in the years ahead. But it's different for every person, which is why we're always encouraging you to reach out, connect with John and his team directly so that they can show you what your options are. RetirementSolutionShow.com, again, is our website where you can go to start the conversation with John and his team. We've also got links posted in the show notes if you're concerned about taxes, or maybe you don't even know what you should be concerned about. As I was saying, the other thing I started with, I don't know what I'm asking you here. There's a lot of that too. I don't know what questions I need to be asking. But obviously, you guys can help us figure that out. So let's start that conversation. RetirementSolutionShow.com.